Okay, so if we think about what we've done so far is we've identified risk factors, okay? We've identified some risk assessment procedures. And then now what we're doing is we're trying to link the risk factor, okay, towards a specific part of the financials that's going to be at risk of material misstatement, okay? And so when we think about the financial impact, financial statement impact of the risks, there are two levels that we need to think about these risks. The first level is known as this financial statement level. It means what are the factors that will impact the financials as a whole? Okay, so factors that are so significant that it will pretty much impact all of the financial statements. So examples there include issues such as going concern, right? So if a company has going concern issues, then chances are, revenues, accounts receivables, inventories, all of that is going to be impacted. Okay? A deficient control environment. Okay, so if companies' controls are not being respected and not operating, then that's going to impact everything as well. Okay, so when we think about risks that impact the whole of the financial statements, they are known as financial statement level risks. Okay, so they have this pervasive impact. Now, the second level of risk is known as these assertion level risks. Okay, so these are going to be classes of transactions, right, or balance or account balances in the financial statements that would be at risk if a particular risk was to occur. And so when we think about assertions, what they are is assertions are like characteristics, okay, or features. So it's the same. So to give you an example, if a company records, makes a recording for revenue, right? Then in order for revenue to be right, okay, so in order for that number, say 200 million for revenue, if that number is correct, then that must satisfy these characteristics. So if we think about for classes of transactions and for disclosures, so these are the assertions for the P&L. So again, let's take that example of 200 million for revenue. So in order for that to be the right number, then first of all, we need to have occurrence, okay? So events have actually happened. We also need to see completeness, okay? So all of the transactions that have occurred have been included. Accuracy is about recording amounts at the right number, okay? Or they need to be recorded appropriately, measured appropriately, and described appropriately. Cutoff, so transactions are recorded in the right period. Classification, right? So transactions and events have been recorded in the proper accounts. And presentation just means that the events are appropriately aggregated or disaggregated and are clearly described. So to say that, well, if things in the P&L are right, then they need to satisfy these 6 assertions, okay? Now, the second set of assertions is with respect to the balance sheet. Okay, so these are account balances. So again, our first one here is going to be with respect to existence. Okay, so assets, liabilities, and equity must exist. Rights and obligations means that the company holds the right to assets and liabilities. Completeness, again, refers to the fact that everything should have been recorded. Accuracy, valuation, and allocation just means the figures are recorded at their right amounts. And then classification, recorded in the proper accounts. And then presentation means that, again, they must be appropriately aggregated or disaggregated and clearly described, right? So this part of the material so far, okay, we have completed a very significant journey, right? Which is that, number one, we need to think about what are the risks out there for the company. Number two, we need to think about the risk procedures that auditors need to think about in order to identify these risks. And then number 3 is that we need to specifically relate the risk to the part of the financial statements, right, where appropriate. Okay, and these risks that relate to the financials, they can occur at 2 levels, right? This financial statement level and also at the assertion level, right? That's going to be a really important process for the audit in order for you guys to pass auditing. Okay, like this is the absolute most important process for this entire module, right? What we just went through. And so again, when I looked at students who typically do poorly in this area, what they do is they identified the risk. So most people don't have, they don't struggle with identifying risks, right? I think finding risks are quite straightforward, right? However, where students struggle is that they are not sure about how their risk then relates to these assertions, okay? Or how does the risk relate to a financial statement level risk factors, okay? And so that's going to be the connection that we need to make sure that you guys are familiar with. And we'll do more examples next week once we finish this in Unit 4. But this is going to be absolutely golden for you in order to be able to pass the exam, is that you must demonstrate this linkage, right, between the risks and how it impacts the financials, right? That linkage is going to be very, very important, and we'll speak more about throughout the module, okay? But I just want